You know, it's really never been easier to buy a ticket to the financial theme park.
Oh, absolutely. It's just a tap on your screen now.
Right. You drop in a few bucks, and boom, you're standing right inside the gates of the global markets. But looking at our stack of sources today for this deep dive into the modern retail trading landscape, it's actually amazing how these incredibly low barriers to entry operate as traps.
They really do. I mean, we're going to dive into two of the biggest lures today, minimum deposits and copy trading.
Yeah, we want to figure out why these seemingly attractive shortcuts, trip up so many beginners and how you can actually approach them like a professional instead.
Which is so important because, well, let's unpack the minimum deposit illusion first.
Yeah, let's do it. The sources highlight this massive misconception where people treat the minimum advertised deposit as their ideal trading capital.
Right, they see a $50 minimum and think, okay, that's what I should trade with.
Exactly. Going back to that theme park analogy, it's like buying a dirt cheap entry ticket. You get through the gates, but you quickly realize you don't have enough money in your pocket to actually ride the roller coasters or, even buy a hot dog.
You're just wandering around inside.
Right. You're in, but you have zero flexibility.
And that lack of flexibility is totally fatal in live markets. I mean, a low deposit reduces friction to test new platforms, sure,
Yeah.
but it leaves absolutely no room for normal market volatility.
Especially with like leveraged derivatives, right?
Yeah.
Crypto CFDs or indices.
Yeah, prices swing.
Yeah.
And because brokers require a maintenance margin, a tiny, say, 2% dip on a minimally funded account just eats your available equity instantly.
Wow, just instantly.
Yep. The broker is then forced to close your position just to protect themselves from a negative balance. You get wiped out by normal noise.
But hold on, the retail mindset here is usually, well, I'll just use leverage.
Right.
The logic is that if they have a tiny account, maxing out the leverage pumps up their buying power so they can ride the big rides anyway.
Which is the exact mechanism that crushes them. Leverage only increases your market exposure. It does not manufacture breathing room.
Okay, so it just magnifies the risk.
Exactly. If you have a minimum deposit and you crank up the leverage, it's like driving a sports car at 150 miles per hour on bald tires.
Oh, man, that's a terrifying image.
Right. You have incredible speed, but the second you hit a tiny bump, which is just standard market volatility, you lose all traction and crash. You haven't reduced risk at all. You've engineered total fragility.
So the trader blows up their tiny account because they couldn't survive a minor dip. What happens next? Our sources suggest this frustration pushes them straight toward a strategic shortcut to compensate.
Right, copy trading.
Yeah. If they can't manage the volatility themselves, they just automate their platform to mirror someone who supposedly can.
It's a highly predictable pivot, honestly. The financial barrier was too hard to navigate, so they try to lower the strategic barrier instead.
But even though you keep total control of your funds in copy trading you aren't handing your cash over to a locked managed fund. You still need that strict risk management.
Absolutely. You still own the risk.
But wait, if a platform like cTrader is perfectly mirroring a pro's moves, they're doing all the heavy lifting, why shouldn't I just view that as passive magic? They do the hard work, I reap the rewards.
Because you are still fully exposed to that lead trader's human judgment, including their bad days.
Right.
Copy trading means real gains, but it absolutely means real losses too. The primary failure point we see in the data isn't technical execution, it's followers' psychology.
Meaning the followers just panic the second there's a dip.
Precisely. A professional lead trader expects a 10% drawdown as part of a normal calculated strategy.
They know it's coming.
Right. But the follower gets terrified, manually closes out the mirrored position at a steep loss, and then just chases whoever had the flashiest returns last week on the leaderboard.
Ah, so they buy high on a hot trader and sell low the minute that trader has a mathematically normal bad week.
Which means evaluating these lead traders requires looking way past those flashy leaderboards. You have to analyze their consistency over time.
Like, what is their average holding period, right? Do their historical drawdowns mismatch your own tolerance for volatility?
Exactly. And what's their fee structure? A trader posting a massive 60% monthly gain is probably taking on astronomical risks that your underlying capital simply cannot survive, especially if it's a small account.
So what does this all mean for you listening to this deep dive? Whether you are funding an account for the first time or choosing a lead trader to mirror, you have to treat your capital as a risk-managed operating budget.
Right. It is not an impulse bet for guaranteed income.
Exactly. Knowledge only pays dividends when applied correctly. Start with enough capital to actually handle normal volatility and spend the time to deeply understand the risk profiles of the strategies you automate.
You really have to look under the hood.
Which leaves us with this provocative thought to chew on. As technology makes it easier and easier to blindly copy complex strategies with less and less capital, will the most successful market participants of tomorrow be actual traders?
Or simply the people who are best at managing the algorithms they follow.
Exactly. It really makes you wonder who is actually navigating the theme park, you or the machine you're strapped into.